My name is Michael True. I'm the co-founder and CEO of Prescient AI. We are a probabilistic attribution and media forecasting tool for D2C brands. Our most recent round was a $4.5 million seed round.
Hey everyone, thanks for tuning in and welcome to the Fundraising Debrief, the podcast where we share the real stories behind successful founders and the recent VC financing rounds. My name is Vlad Cazacu and I'll be your host today as we interview Michael True, a seasoned sales leader turned founder that followed a systematic approach to finding out how to raise capital from the right people and has opened up about his playbooks in today's episode. If you're a founder in the B2B space, you will not want to miss this conversation. For more information about running a successful fundraiser, including show notes, highlight clips, and exclusive scenes, follow us on Twitter and Instagram at The Fundraising Debrief, as well as on our website at thefundraisingdebrief.com. This episode is brought to you by Flowlie, the number one choice for secure deck sharing and fundraising automation used by thousands of founders from 50 plus different countries. Now, let's dive right in. Hey Michael, such a pleasure to have you on the podcast. Thank you so much for accepting our invitation.
Yeah, of course. It's good to see you, Vlad. Thanks for having me on.
I'm really excited about this because I think a lot of people have a lot to learn from your experience fundraising, and you have a very interesting story to share with the audience. But before we dive into the actual fundraising nitty-gritty, I'm curious if you can share us a little bit more about Prescient AI and what you're working on for the people who are not familiar with your company.
Yeah, of course. So Prescient AI is a probabilistic attribution company that layers on the ability to do digital marketing forecasting. We're working with D2C brands. So you can think of like companies selling things on Shopify, as well as the D2C agencies that are buying media on behalf of Shopify brands, and now starting to work within the ecosystem of D2C tech companies as well through various partnerships. We've been doing this for building and researching this now for a few years and have recently went live into the marketplace about 5 months ago.
Fantastic. And what prompted this company? What was the genesis of it?
Yeah, man, it's interesting. I never thought I would be in e-commerce. I never thought I'd be sitting here with this podcast talking to you today. The plan was to build a little bit of some tech and sell it off to a music platform 5 years ago, actually 4 years ago. I built a tour prediction model that essentially would predict where artists should go on tour. Essentially, it's kind of like pre-bands in town tour, their touring recommendation. And then COVID hit and touring went away. And I met my co-founder, Cody, and we shifted our focus to measuring the impact of digital marketing on album and track releases for Spotify streams. And so Cardi B is going to go launch a song. The label's going to spend X amount of dollars on that song. What is exactly driving those streams? It was a tough problem to solve, right? Because in music, there's no last click. So currently today you're running ads, you can see what that last click was, and being able to do some sort of measurement. In music, there was a whole bunch of noise in Cardi's world. There was a bunch of spend, and then you had playlists and radio and pre-saves and all of this noise virality. So identifying and pinpointing down what was actually impacting those streams was a challenge. And so that was the initial problem that we set out to solve.
So how did you pivot from that into where you are right now around all paid advertising, not just music?
Yeah, I mean, it was a fantastic question, man. It was quite the journey. It was Cody and I in the middle of COVID in a digital garage. We partnered with a major record label. We got all of the historical data. We built a model that was predicting streams between 93 to 98% accurate. And then we started providing the label saying, hey, if you shifted the spend from this TikTok campaign to this Facebook campaign, this is how many more streams the artist could have gotten. And it was February 2021. And the artist was Cardi B, and she was coming out with her up release. And they took our spend recommendation. We ended up predicting her number one billboard. It couldn't have happened without us. There's nothing else to do with her song, her music, or anyone else. It was just the spend. But we ended up predicting that song at 96.3% accurate, and getting ready to do a deal with the label. And the very next month, Apple announced this thing called iOS 14.5. And that is what caused a ripple in the ability for digital marketers to manage their spend. And we quickly realized that the type of model that we had just built, because there's no last click in music, was going to be in high demand as more privacy features came out. And so we decided to say, hey, instead of going to do this with a record label, let's go raise some initial capital and get an MVP together And at that time, COVID was just going crazy. And so e-commerce, as you can imagine, the spend was up. People are at home buying as many products as they can. And the problem was becoming more and more difficult for marketers to measure the spend in e-commerce. And so that was really the catalyst to set our sights on a larger vision.
And at that time, how many people were working on the company? Because this was still pre-first raise, right? So it was still in the bootstrap period of Prescient AI.
Yeah, it was just Cody and I, man. I had raised like $50,000 of angel money to build the tour prediction thing, and so we were, truly bootstrapping it, and we got $25,000 pilot with the label that kept us going, and then they liked what we were doing. We got a $50,000 pilot, and then a $25,000 pilot as we started to improve our model and add more artists onto it. But yeah, it was just him and I for the entire time. It was pretty cool, man.
Fantastic. And at what point did you say this is the time to raise some additional capital, increase burn, hire more people? This is really a thing. It's not just us anymore.
Honestly, it was he sent me a Slack saying with the link to iOS 14.5, and he says we can't do a music deal. I was like, you're right. And then he sent me another link to total digital advertising spend in 2020, and then projections up to like 2026 globally. And it was like a $500 billion. And he goes, this model will work against every single dollar spent, regardless of the industry. We should go raise capital. It was pretty much that day we started saying, you know, we've never raised like traditional venture capital before. Like, what the hell do we do? Where do we start? Like, neither of us come from I don't come from a big, I'm from Portland, Maine, very blue collar city. I didn't have Sequoia in my backyard or really any tech in my network at that point.
So what was that first raise like for two people without a pre-existing network, but knowing that they're sitting on a gold mine?
We got into an accelerator that was a sports accelerator. And we were like, hey, where do we apply this model? Like, we know there's an entertainment play. So once we got in the accelerator, we started to build a little bit of a network. We got, I think, our first $250,000 safe agreement. And then from there, we knew we wanted to raise like 1.5. And so we knew we needed like larger tranches of that to come through. And so we started leveraging the existing investor to leverage their network. And that was it, man. We just started talking to as many people as we could. And eventually the round started to come together.
And fast forward to this round, right? A $4.5 million seed round, a more established product, more revenue on the table, a more experienced fundraising team. Now, having gone through the journey at least once before, how did this round came together? Where did you start?
Yeah, so once we finished the pre-seed round, there was a fund called Green Egg Ventures out of New York, and Alex Ferber over there. Shout out to Alex, great guy overall. He had mentioned a fund called Blumberg Capital, and they had invested into companies like Braze, which Martech companies, right? Braze that seed to a 9 billion IPO, Double Verify 3 billion IPO, Pro. And so I said, I want them to lead our seed round. And so the next week after our pre-seed, I started the relationship with one of their associates over there. And we talked throughout the entire year. And as we were starting to hit the right inflection points and we opened up the round, we were able to, we got, I think, three term sheets in the first 30 days. And Blumberg was great. I really felt a good vibe with him throughout the diligence process, throughout the year. The relationship was established. And so for us, when we agreed upon the terms, it was in our mind a no-brainer to execute on the round with them.
It's very interesting you mentioned right after the pre-seed starting to build a relationship with that particular fund or with other investors in general. How are you viewing that in between rounds time as relationship building / fundraising time spent out of your daily schedule? Is that something intentional always for the next round, or is that something that came just because that particular fund was very exciting to you?
Yeah, I'm actually going to do a quick rewind back to the pre-seed round, right? Hey, we're going to go put this deck together. We're going to try to go raise some capital. We got into an accelerator. We still don't really have any clue of what the hell we're doing, but we know we have this great model, right? Man, we pitched so many funds to get this round done on the pre-seed. And in hindsight, one of the things that I'm most happy about, and my big recommendation for other founders out there, is when you get told no, it sucks. But in my mind, it was the best piece of information that I could have ever gotten. and asking the question, well, what would you need? What do I need to send you for this to be a yes? What do you need to see? And we were pre-revenue. We needed to get the product out the door. We needed to go do a bunch of other variety of things. And so I documented every single one of those no's. I bucketed them out into things like hiring, bucketed them out to things like long-term vision, financial models, product development, but update them like crazy. But you would kind of keep in your back pocket. It's like, hey, listen, I know one of these, and be like, hey, here's what we think we're going to go do over the next month. And some of those things are like a stretch goal, but you kind of know in your back pocket, like you're going to get this done. And so when you started updating these investors about reaching the inflection points that you set out to do, aligning them with the reason and justification for their upfront no's, the time was very well spent really documenting that out and over communicating with the venture community in a very tactical way.
I like this concept of over communicating in a very tactical way. So I'll have to spend a little bit more time on this. What is the right tactic to use in this case, right? You are now sending updates to some people who said no in the past for the current round or for the future round.
Yeah, so going into the pre-seed round, a big thing was you guys have to have the ability to get the data into these models, right? And it's a daunting task to go do that in some senses with APIs and integrations and so on and so forth. And so an example of that is just we would talk about the integrations that we had on the roadmap. And these folks have a good sense of like the difficulty it takes to get those up and running. And we would update saying, hey, we have Shopify GA and Google Ads baked out, and that was in the first 21 days, right? How are you going to get your model into deployment? These type of models are finicky, they're fragile. And we got our first model in deployment 45 days later, right? And so we'd send them updates. And then, hey, you need to get a product exec, you need to get a head of engineering. Oh, we recruited some of the best talent in the game at such this early stage who are bought in to come go work with us. And that was a type of tactical communication that was largely pre-revenue, right? For folks that are trying to go out there and figure out, well, I have this great idea, there's a business case, there's a problem, and we're able to prove those success points. Post the pre-seed, and now it's like, all right, well, you have the money, you're building, right? How are we going to start getting to revenue? And this is where instead of some folks, and maybe it's the right for your product, for ours it wasn't, like going out and doing this thing on Product Hunt and having 500 people sign up and download your platform and try to see who converts and who churns and why. For us, I said, let's go get 8 D2C brands, right, that believe in what we're doing, and for free will help us give feedback on our UX UI. We had pre-scheduled calls. We had Slack channels with them. It was truly an integrated partnership, and saying at the end, we're going to try to sell this to you, right? And then can we hit those conversion rates throughout those design partners, right? And then you can start to do multiples from there, saying, hey, if we have this conversion rate, then we have a wait list of 200 brands, right? What does this look like as we start to go into more of that seed round conversation?
And were there any people that reviewed those updates who were initially a no and then transformed into a yes?
Yeah, there was one fund. Yeah. A guy named Andrew Beatty from Side Door Ventures. He had given us some initial, I forget what the exact thing that he was looking for. He was very interested in seeing the back testing and accuracy of our models, right? Because people are going to believe this type of measurement. They want to have some confidence that you can do it outside of the music industry. And yeah, we got our first Shopify store that came on. We got their data, we ran it through the model and predicted their last year of revenue out of sample, doing a holdout essentially, 89% accurate, just using their spend, impressions, click sessions, and revenue. And that was kind of not only him, but that was kind of everybody's like, aha, oh shit moment. Like, we're just getting started with this model, and this thing is already interpreting and back testing at a level of accuracy that is typically above that 80% threshold that the brands feel confident in.
Interesting. So I'm curious, post that pre-seed round, sending updates and building relationships with new funds in preparations for your seed, how much, quote unquote, of the seed fundraising work was done before the round actually happened? Or before the round actually started, to say better?
A lot, man. I had an investor list of 80 funds. I have this investor matrix that I put together, and I got very to keep using the word tactical, but like within these funds, I had baked out like previous investments they've done, who is the partner who specializes in our sector, who has experience that can provide strategic value. Some of the funds I've talked to, some of the funds I said, I want to go build a relationship with this partner. And I would send consistently monthly updates to just to stay on the radar. Not every month was like this whole like, oh, wow, sort of extravagant thing, but you're cognizant in their mind, you're fresh on their radar, and they can see that you're running a really tight process, and being able to do that when you have limited time to making sure that you're staying on their radar. It kind of shows like a good faith, like, hey, we're interested in you for specific reasons, right?
And we've had this debate in one of the previous episodes around how much information is too much to share. What are your thoughts around prospective investors versus existing investors and the level of transparency that you're sharing with both parties? Is it the same? Is it different?
I think it's your existing investors are always going to get more information about what's going on with the business, right? You are sharing largely the bad news with your existing cap table, right? They can, what do you want, a pat on the back for letting them know how good you're doing? I think it's important for their internal reporting, but here's where things are not going well. Help us out with that. I think communicating with the external investors is, it's largely tied to like where you are in the product build, where you are from a revenue perspective, and making sure that they are aware of the inflection points that you're looking to tackle, right? And making sure that you're communicating with them on what those inflection points are. Again, for us, like we did our pre-seed round to really fund the infrastructure build, the UX UI build, and the product build, not so much using the pre-seed fund to go out and scale revenue at that time.
And that was the seed round coming forward was particularly focused on scaling the revenue ops. Is that correct?
This most round, yeah, this is when we really started scaling. We went from, I think, 6 employees to 11, getting customer success on here, getting some marketing, expanding our engineering capabilities, really taking some promising math and getting it to a place that's easy to access through integrations and easy to consume through an intuitive dashboard.
And if I remember correctly, this round was not entirely equity or had also a debt component. I'm curious to explore this a little bit more on how you were thinking about equity versus debt or adding some debt to the round for the success of this opportunity.
Yeah, so we did the round. I wasn't really thinking of debt, to be honest with you. It's funny because it's good story on the debt. We weren't really thinking about doing any debt. And then after, I think, our second board meeting in Q1 of this year, the board brought up saying, hey, listen, like it can't hurt to have an insurance policy, right? With the right terms. We don't need to draw down on it immediately, but having it in our back pocket with the market conditions isn't the worst idea just to go explore. And so we got in touch with a venture debt bank and we went through the diligence and getting everything ready to submit it. And then the whole catastrophe broke loose about what happened is literally the night before I'd finished all of the documents. Venture debt can be used in multiple ways, right? So you could think about it as you don't want to use it as a vehicle saying, hey, if we're going to be running out of cash, like runway extension is great for it, but like you want to get to a point where you have like predictable, repeatable revenue. And it can be used as a vehicle saying, hey, we're going to go raise a series A for $10 million, but we're confident in our revenue. We're confident in that $9 million will get us to where we need to go. Right. And so you can use that essentially as an insurance policy to raise less, take less dilution down, and always have that in your back pocket. You can also use it for you're going into the enterprise and you have $2 million in the pipeline, right? And you think you can close these deals in the next 6 months, but you need to dip into that debt a little bit, right? Because it's going to be worth it. Closing that $2 million is going to skyrocket your valuation for your Series B. And so we kind of think about this as a long-term vehicle versus scramble to the bank when things go wrong.
And how are you thinking about dilution? Because you brought it up, which I think is a very interesting topic to delve a little bit deeper around the pre-seed and the seed round. Did you come to the target dilution, figure out exactly how much money you need to operate on those targets and then take that regardless of what the valuation is? Or were you flexible on how the round came together to also protect as much of the pie that you can have?
It's such a fantastic question. I think there's multiple opinions on how founders think about this, right? I started looking forward and saying, like, where do we think we can exit this company? How many rounds is it going to take us to get there? And what is the estimated dilution of going through a Series B, C, so on and so forth, right? And then working backwards from there. We got really crisp on our financial and operating model of who we'd need to hire, what our growth rates and what our growth projections would be in order to get us to that Series A at the valuation that would fit within our target dilution rates. But there was some flexibility here for sure. We were not generating much revenue at all when we did our seed round, right? It was still really driven on the promise of the design partner phase, the timing of the market, not timing of the market, the timing of the applicability of the technology that we had across the MarTech ecosystem. And so we knew we had to have some flexibility of aligning that as well as who we wanted to give our first board seat to, who we wanted to lead our round, who we wanted to go on this journey with. But in closing, my recommendation would always be, don't think of your dilution rate now. Think about where you'll be diluted at when you would ideally have some sort of liquidation event.
And how does that piece of advice change when you may not have as many investors interested in the opportunity at hand?
Best advice I got from my buddy was, even with like advisors and stuff like that, like, like you get very protective over, small basis points of your equity, but you can't win the race unless you show up. And a lot of the times you can't even show up to that race unless you have the capital. We had parameters that we would not go below. And a lot of the funds, they're reasonable too. You don't want to go into have somebody take your board seat or work with a venture fund that's just going to try to gouge you out of the beginning. And for us, like, you think about the year before that, valuations were at an all-time high, right? These investors were struggling to get, not struggling, but like, you're doing some things like 7%, 10%, 12% ownership on a seed round, right? And so when the market crashed, a lot of VCs were saying this is an opportunity to take advantage and get more ownership of these companies based off where the market was at. And the investors that we worked with were very reasonable about being founder friendly up front.
Absolutely. I think there's this like mix between finding the right partner on the other side of the table and also coming through a position of strength by proving the matrix, the metrics that you need to prove in order to get the round done. Like, it's always two sides of the coin. You can't only rely on the kindness of the other side of the table.
I mean, some people say like, dude, you're doing this amount of revenue and you raised $4.5 million in this market. It was like, we spent a ton of time on the vision of this company and like really cementing in like why this can be a horse that they can bet on. Why is this going to be the winner? Why is this going to be the next 9-figure SaaS company, right? And you get people who know your space. You get people who believe in your team. And I call them like the 4 T's: the team, the timing, the traction, and the tech. If you can blend those 4 T's together, you can create a pretty compelling story within the tech space, that is, anyways.
And I would like to take a step back for a second because I like where we're going, this compelling story, but I think we're missing one element that disconnects the start of the round with the 3 term sheets you got at the seed, which is that process of in between with how many people did you start, how many meetings did you have, and how did you funnel towards being able to have 3 term sheets in the first 30 days of starting the seed round.
Yeah, I bucketed our investors in like, there was our top like strategic VCs that are like, there was like strategic capital and then there was just capital, right? To show up to the race. And I had quarterly calls with our strategics. We bucketed out into 10 of them. And there was about 40 other funds that we would send email updates to. There were a couple of them that were, when the email updates would come in, being like, hey, listen, I know you're busy. I'd love to hop on the phone with you. And you plan your calendar accordingly and you take calls. You can't bet the farm on one of those or 1 or 2 or of those strategics coming on, right? You need to have a backfill. And so didn't spend 30 minutes a month, with some of our strategics, and then really just communicating through email throughout the year with some periodic calls with them.
And were there any new investors that came in the round, were part of the conversation from the moment you said we are raising a seed round, as compared to the ones that you were already building a relationship with and keeping them updated?
Yeah, we had one, our lead fund took the majority of the round, and then we had been communicating with Bloomberg throughout the year. And then there was another fund called the CES Investments, family office here down in Southern Florida. And we got introduced to them in the later stages. And they drove down to Miami. It was actually pretty fast. We had a really great call with them. They came down, we met, went up there, and they really specialize in like large scale enterprise platforms and a lot of affinity there. So it was great to see, like, for use cases for other folks out there, like you can nurture somebody all year long, and then you could get introductions as the round is starting to get announced and term sheets will start to come in as they go.
And who are those best paths of introductions? Because I don't think all introductions come with the same weight behind them.
Leveraging founders who are within their portfolio companies. I send our cap table a ton of deals, but leveraging founders that were within their portfolio company is a great advocate to at least make sure you're going to get some eyes on that. I would go on LinkedIn and look at some mutual connections if I knew somebody that was close enough and be like, oh, I knew there's one, they like went to college together and they played on the same sports team. And I was like, I know that you know this person, like, let's get this deck in front of them. But when you have ones that carry the most weight or other, obviously, I think other VCs to other VCs that invest in that same ecosystem, founders within their portfolio companies, and then trying to find a warm relationship between the two of them. And then I don't call it bottom of the barrel, but I would say the least likely of getting in front of their eyes is just sending cold emails, LinkedIn messages, and submitting your deck within their website.
So do you believe those options, that the cold submission is doomed to not work?
I'm a sales guy at my core, man. I grew up in, IBM, Oracle, going through sales school and stuff. And you have to realize, like, in order to typically get a meeting, like you're doing 6 to 8 touch points is for somebody just to respond to you. So I would not go in there and say, oh, I submitted my deck. They're going to be so excited to see it. Like this is the biggest thing in the world. We're going to get a call back. We're going to get a meeting and we're going to get this term sheet. We're going to go build $1 billion company, right? It's like, you have to do the touches, message them on LinkedIn, submit it through their website, find their email online, find mutual connections, right? So you have to have multiple touches. And more often than not, like, you'll end up getting a response. A lot of the times, they're like, hey, I'm so sorry, this looks great. I've been so busy right now. Let's set up a tagging X to set up a time for us to chat.
So I love bringing in the sales expertise of your past career, let's say pre-founder career, into this. What are the similarities between running a sales process and fundraising?
When you're selling a deal, you always outline a success criteria, right? And there's many acronyms, but like, use BANT, for example. You have budget, you have authority, you have a need, and you have a timeline. You want to check those boxes before you get a deal, right? And you're aligning what is the success criteria or the value prop of, call it, your software that aligns with the client you're going to go sell, right? Same thing when you're talking to an investor, right? You're sending over on the sales side, you're sending over materials about how valuable your product is, success stories of how well it's worked with other clients, right? What you're looking to accomplish in the relationship. The same thing with the VC, right? I wouldn't use maybe the BANT. Well, actually, it could be applied to that, but like, if they raise, if they're deploying out of a fund, they have the budget, right? If you're talking to a partner, they have the authority, right? Where the market at? Is there a need for? Is it competitive? Are people deploying capital? And is there a timeline of where you guys could work with something to get it done? But always aligns to the success criteria, right? Do you have to fit a certain success criteria or an investment thesis that are usually tied to the team, the timing, the traction, and in our case, the tech? So I see there's a lot of crossovers in between the two of them in that sense.
And authority is a really interesting point out of the 4-step criteria, because I think a lot of people are gravitating towards, if you're not yet speaking with the partner, the deal doesn't matter. What's your approach around associates, principals, VPs, kind of pre-partner conversations or pre-partner intros?
A deal doesn't matter if you're not talking to a partner. It doesn't matter if they're the one who's going to approve of the investment. I think it's very short-sighted to view speaking with an analyst or an investor, a principal, because you get to learn, right? And you get to cultivate that relationship. With Blumberg, he's now at HBS, a gentleman named Leor, but, he was just an investor there, right? And I talked to him all year long and ended up getting to go to a dinner, invited to a dinner where the managing partner, Bruce, was at, and we sat down and we chatted, but that never would have cultivated unless, you can really get a lot of information from the investors or principals about what that success criteria is, what's going to make the funds tick, what is going to get that deck or that, what is it going to take for them to bring in Prescient AI to their weekly deal review.
Leveraging the associates, the VPs and principals to build relationship and just get a better understanding for when you have your shot to speak with a partner and build that relationship, have, all the aces up your sleeve pretty much.
Yeah, I think it'd be like, I don't know, working with a talent agent. It's like, hey, I want to get on this movie, right? And you're working with a talent agent on like, what skills do I need to have for this type of movie or some sort of entertainment? And you're refining your skills and you're going back to them and talking about and showcasing all the new talents that you've acquired, right? That's the same relationship you have with the investor, right? And when I was communicating with them between the pre-seed to the seed, right, I wasn't talking 99% of the cases to the partner during those times. That's your audience, and that's who you need to cater to and learn from and deliver for, with the understanding of, that it makes no sense to talk to the investor without understanding what do y'all need to see in order to get our deal in front of the partners to have a thoughtful conversation when we open up the round.
I think it's the second most unique comparison. Now you're talking with an agent to be casted in a movie. I would say probably the most unique was you're looking for fellow soldiers to go to war together. That was a previous episode, but I like this, so I appreciate you bringing that analogy.
It's just a very interesting and tough journey to go through. And when you find that partner, or you get in that movie, or you successfully leave a war, I don't know if that's like how to say that, but it's a rewarding feeling to see like what you and a small group of people have like really put your mind and soul and body into over the course of months and even years.
Absolutely. And I'm curious to hear your thoughts around this relationship building. You mentioned the associate conversation that led to a dinner with the partner and being in person and have that conversation. In the age of, let's say, COVID and post-COVID, primarily Zoom experienced world, how do you see in-person relationship building versus remote fundraising and where that line is?
I mean, people Zoom, it's tough, right? Like there's nothing more from like a relationship building perspective, shaking somebody's hands, feeling them in your presence, seeing their body movements. You can see a lot more in a person when you're standing next to them than with a blurred out room in the background and talking through a video. It's drastically different. Obviously, it can be done. There was a lot of capital raised during COVID. But I feel like that human element of it goes a long way. We opened up the round in, I think, June of last year, and COVID was kind of, people were starting to be out and about a little bit more. Yeah. We ended up just doing a road show up in New York City. And I think we met with 10 funds over the course of the week, and just night and day of like sitting down in a conference room and reviewing the materials and building rapport with them, bringing in coffee. It's tough to send somebody a coffee or sit down with them like over dialogue like that. It's just a little bit different.
Interesting. And what about board meetings now that you actually have a board? Are you hosting those in person versus remote?
The first two were remote. The last one we just did was 3 weeks ago. I was up in New York in person. It was great. Yeah, we had a really solid session. Went out to dinner after, invited some of our other investors there. We'll do the next one down here in Miami.
And spot on what was supposed to be my next question around Miami versus New York versus the Bay. For founders who are not based in, call it tier one cities, like you and I, for example, based here in Miami, what's the opportunity cost for not traveling to New York and SF to make those relationships in person and relying on the local network in a tier 2 or tier 3 city in the United States?
Wow. It's a loaded question, right? Because it's very subjective to the company, the product, what they're looking to build. I'm just a believer, man. Like I think maybe from my IBM days with my last year, we did 134 flights that last year. And like, we were just FaceTime all the time in front of clients and talking and building relationships. And I wouldn't go spend on this like massive roadshow, right? That was kind of like unplanned and not very thoughtful, right? But if you have some like highly strategic investors that you have a strong understanding of what they're looking for, you either one, go out there and meet them to really build a relationship and really dig into what they're looking for, or you have a pretty good sense that you have what they're already looking for, and you go out there and enhance that relationship there and look them in the eyes and walk through and make them believe in why they should put capital in behind your business. So it's easier for us. It's easy for us. Like we're spoiled, right? I lived in SF, I lived in New York, I've lived here in Miami, and it's a different dynamic out there. If you're in like Sarasota, Florida, or Knoxville, Tennessee, or Topeka, Kansas, right? There's funds out there, right? But it all depends on who you're looking to go to war with, or what movie you're trying to be in, or who you're trying to marry, right?
That is true. I do think the analogy still holds for when you're looking to specific cities, because those would be things you would consider in either of those three scenarios, right?
Yeah, fair enough. Yeah, exactly. That's a good
So,
point.
I'm curious, as a wrap up to this episode, before we jump into the rapid fire questions, is what would be one piece of advice that you would give founders from a mistake that you've actually felt on your skin in pre-seed or seed, something that you've done and really made a mark of saying, yep, not that again, or yep, the complete opposite?
It was the learnings of really learning to understand the no's and document. I wish I did that earlier. It's the best thing that helped me understand was like, what is it going to take to get to a yes? I call them, I wouldn't have happy years, right? You talk to a fund, you hear one good thing, and it's like everything's going to happen now, right? But you completely disregard like the core ethos of like you had one good call as an intro call. You typically get that generic message of, this is really cool. It's right up our alley. Like, make sure that you stay in touch with us over the next 3 to 6 months for your traction. But you didn't really appreciate and digest the type of questions that they're asking and really looking into trying to understand what some of those hesitancies can be and not asking them the right questions up front, right? Getting that tough love, that tough feedback and embracing it. I wish I did that a little bit earlier. And when I stopped doing that, everything changed.
What were some of the hard questions that you asked that truly ignited that insight on your end?
I would say outside of just your typical investment theses, what are the exact benchmarks that you would need to go in that says, I check, from a financial perspective, from a team perspective, from a tracking perspective, like give me some tangibles that are quantifiable and measurable, quantifiable or qualifiable that are measurable that I can come back to you with.
I love that. And when they're not open to sharing that, or when they give, not necessarily not open, but when they don't give a clear answer, when they still put you in that gray area, is that just a sign for you to walk out?
In hindsight now, yeah, I'd probably say like, all right, you're not a good partner for us. Like if you're not going to be transparent of like what you're looking for when we're trying to prove value for you and go build and help us, right? What is that relationship going to be like after the cash is deployed or after the investment's done? But easier said than
Fantastic.
done. Easier said than done, right? Like when you're out there raising, it's like
Absolutely.
I don't care. Like I'll hit you back in 6 months with this big update, and if we do a round, like great, I have cash in the bank. Let's go.
It's hard, right? Because like there's always that incentive on your end to just raise more capital, and unfortunately, it's not up until one point when the wheel starts spinning, someone else holds a little bit more power in that decision than you do.
Correct.
So curious to jump through some really quick rapid fire questions on you as a person. What is one thing that people don't know about Michael True that they should know about you?
I'm largely an introvert, and I don't think many people get that feeling when they're socializing with me or interacting with me.
Interesting. One person that you consistently look up to throughout your career, one or few.
Some people I've looked up throughout my career. There was this guy, I would say, Patrick. It's not like a known person. His name's Patrick Keaton. He works at IBM. he, uh, I would say, just like for non like Patrick Keaton of a human that just like operates like an absolute machine. Rob Thomas from IBM, from an executive level, and then just from like a pure like CEO of a startup perspective. Definitely Ted Krantz from App Annie is somebody that I've always looked up to, in the work that he has done from a culture and just growth perspective.
Interesting.
So I gave you three,
One
but I wanted to bucket them out.
I appreciate that. We always appreciate non-popular or non-famous answers because it brings a little bit more uniqueness to the answer.
Yeah, it's like, oh, I read a book and like I love this person. It's like, no, like I want to tell you people I look up to that I've seen them in the trenches for,
Indeed. Two more. So the penultimate one, at some point you took an extensive travel hiatus, a travel break from work. What was a favorite experience during that time?
It's probably the Byron Bay's Blues Festival, on Eastern Australia. Just magical, man. drove up there in a camp, lived in a camper van forever, and just sat there and just listened to some of the Lumineers and Bonnie Raitt, and it was cool.
Very different than sales and fundraising, I would assume. A little bit more relaxed lifestyle.
Yeah, when I do escape, I mentally just go back there.
And last but not least, as we approach the end of this episode, who would you want to say thank you to in regards to your company, your fundraise, or your career in general? But you'll only have to pick one person.
It's so easy, man. My co-founder, Cody Greco. I've never met a human that is like this man before. He's my CTO. He's just a brilliant research scientist, data scientist, engineer, leader. He can do sales calls. He can think marketing. He's just somebody like outside of his talent, man. We've went through just the lows and lows and lows of building this thing, man, and have somebody in the trenches with you that just fought through is, regardless of however this plays out, I'm forever grateful just to watch him and experience the time we've had together. And that was the easiest question I've ever had.
Fantastic. Always great when you get the chance to work with someone you truly admire and then be with them every single day, building something amazing. Michael, thank you so much for joining us on this podcast. Really much appreciate it. It was such an engaging conversation, and looking forward to have you on the podcast again when you raise your Series A.
I love it, man. Thank you all so much for having me, and it's great to see you, Vlad. Thank you.
What a great conversation. If you enjoyed it, make sure to like and subscribe to our podcast and be on the lookout for a new episode in 2 weeks as we interview another amazing startup founder and debrief their successful fundraising story. This podcast was made possible by Flowlie. If you're currently fundraising or planning to do so in the near future, create a free account today on Flowlie at flowlie.com. That's FLOWLIE.com. And get access to an investor database curated just for you and powerful deck sharing capabilities with advanced access and engagement tracking. Are you ready to take your fundraising journey to the next level and join thousands of founders across the globe who use the platform every single day? Find the discount code in the show notes and sign up today. That's it for today's episode. See you next time.